The stock market does not follow the so-called real economy. It only follows one thing. Basic investing advice from the past may have been, look around you and see what is selling well at your supermarket, at the shopping center, when you're driving down the street, where you're seeing lines of people going to buy a product. And that worked pretty much all the way up until the GFC. If you followed that tried and true investing advice, then you'd be absolutely confused right now, or at least thinking we're in recession. We've officially just crossed the border of the top 10% of Americans now contributing more than half of all consumer spending. That means your companies like Gucci, leisure spending at massive hotels, casinos, and even Ferrari, those companies are doing very well. Ferrari's stock price has times 12 in the last 9 years. Whereas if we look at another international car seller such as Honda, a cheaper brand, they have effectively been at standstill. And I think the same idea applies to the AI bubble, both in terms of the AI data spending, the infrastructure cost, but also in terms of the stock prices of these names. In this case, we're talking about the top 100 wealthiest people in the world. Many of those are now in the AI tech space, and they're voting with their shares to say, look, we're spending hundreds of billions of dollars towards AI. In terms of the physical economy, we as everyday people don't see that money. We don't see billionaires getting extra $100 million. They're not going down to your local shops and buying new shoes, or even the local car dealership. That's not really good enough for them. So it's almost like we've got two circular economies going on. We've got the bottom 90% who are just spending on their groceries and everyday cost of living, not really getting ahead. And then you have the top 10%. Yeah, they're having some play money, but maybe most of their wealth is flowing into the stock market, and that is making them even more richer. And we can see this in the data. This chart here is kind of interesting because it's also self-correcting. We have that the top 10% can now afford 11 weeks of their average expenses. Again, rich people spend more money, so it's probably much higher if it's in terms of average spending, whereas the bottom 90% can afford less than 4 weeks worth of cost. That's where we get this idea of living paycheck to paycheck. But when we had the GFC, we had to crash interest rates down to zero to help support a economy on life support. Now, during that time, the wealthy, as long as you had $1 million at least, you were slowly buying up assets, especially in these tech companies that were growing fast and weren't really making a profit yet. You could accumulate a huge share in these companies. And then as we got closer to 2020, 2019, these tech companies were ready to rip higher, explode profits to the moon, doubling almost every year at that point. And then during the pandemic, we even had the Fed print $4 trillion to stimulate the economy. And after that point, unless you had, like I said, $1 million, getting into that top 10% became almost impossible. We have seen that in the hard data, but it also plays out recently in 2025 in terms of the soft data. So far in 2025, we've seen 500,000 women leave the workforce. They quote factors such as burnout, higher childcare costs, and return to office mandates just not being flexible enough to support their lifestyle.
The best thing would be to start with a job.
No.
Yeah, absolutely,
No.
she needs a job.
This is having a huge effect on our economy and is pretty much the single-handed reason why we've seen the job growth in America being at recessionary levels for the last 4 months. And rather than making this a political channel and saying how the government could fix this issue, yeah, there's things they could maybe do, but I'd rather focus on things that are pragmatic, that have actually worked in the real world. So to answer that question of how do we get into that top 10%, well, it looks like from the statistics, it's not through working in this so-called real economy. If we remove the increase in GDP from large tech companies spending on AI projects, the American economy in the first half of the year was only going to grow 0.1%, pretty much recessionary. So we have this idea that maybe if we could get a job for these big tech companies, we could get a big salary, and that could be our ticket into the top 10%. But I think more and more with this AI age, even that answer is getting harder and harder. In the past month, we've had some of the best companies that are benefiting from this red hot part of the economy, like Amazon. They have cut 30,000 corporate jobs, the largest cut in their history. We also have Applied Materials, who work on high-end tech manufacturing, they have cut 1,400 workers. Meta, they have cut 600 AI developers, literally the best type of job in this current economy. Even they are getting trimmed. Google cut 100. Texas Instruments, who are trying to get their fingers in these AI pies, they cut 200 jobs. So again, this story of getting a job in AI maybe is not reliable. That really leaves us with only a few pathways left for everyday people to try and claw their way into the top 10%. And both of these ways are kind of traditional in some ways. We have classic careers such as doctor, lawyer, plumber, electrician, owning a small business in a thriving somewhat area. Those are still good ways to bring home a fat paycheck. And that leaves us with the final way we could maybe get into the top 10%. And that would be investing directly in these successful AI tech companies.
You're definitely happy if you own NVIDIA. You know, a question we ask all the time is, okay, you own NVIDIA, but would you buy it now, considering the run-up it's had? Well, it just continues to go higher. It is opening at a $5 trillion market cap.
So we have this mission of buying up the stock market. We need a reliable indicator to see, is now a good time to buy? Do I just plow in all my savings? Again, looking at the real economy is not really the answer here. And that leads us to the one thing that the stock market cares about. The only thing. That formula may not be a sexy quote that you can whip out to impress people, but don't worry, nothing we're going to whip out is going to impress anyone. We have here Google a year ago was only priced at around a forward P ratio of about 16, but moving forward, it was growing profits somewhere around 25 to 30% year over year. Whenever we have this idea of cheap valuations plus impressive growth, that just tells us we have an absolute deal on our hands. Working with that equation, predicting the stock price, I was penciling in about 70% price growth for the next year, and Google outperformed my expectations. It's increased 84%. Even better here, I've got an example that could maybe play out in the next year. So this is just golden knowledge for you guys. I hope you're enjoying it. Hit the like button, comment down below if you want to show support. But Meta right now is a company sitting in about that same position. Meta is sitting in this almost similar position. It has a forward P ratio around a 17.3. Again, that is assuming roughly 30% earnings growth for the rest of this year and moving forward. So if we're paying around 17 to 19 forward P ratio for 30% growth, again, that just gives me a lot of confidence to invest in a single company. And if you want to keep tabs on a portfolio that follows these principles, and let's just have some fun and see if this portfolio beats the S&P 500 in the long term. If you enjoyed this video, I've got two more that the algorithm has picked for you on the screen here. Hope to see you guys there next. Bye.